Hi everyone. I wanted to take a few minutes to discuss the recent market volatility we've been experiencing in 2025 and particularly the market pullback this week. So we entered the year facing several challenges, including high stock valuations, concern about AI spending growth, persistent inflation in some parts of the world, which could impact previously expected rate cuts, uncertainty about the effects of tariffs on the US and global economies, and potential trade wars. The main trigger for the recent market volatility has been the erratic and often contradictory policy announcements from the US government, particularly concerning tariffs, public sector cutbacks, and relations with allies. I'm actually currently in New York, and it's been really interesting to see firsthand how the Americans are reacting to Trump's administration and policies. And while I've only sort of observed a small portion of the population, the general sentiment here, at least in New York, seems to be one of frustration and embarrassment over the recent actions by Trump and Musk. And while many, myself included, agree that rising government debt levels need to be addressed, there is strong opposition to talks of taking over other countries, policies involving aggressive tariffs, mass deportations, and government layoffs. I think the recent Wisconsin election result seemed to reflect this broader sentiment. So focusing on the recent tariff announcement, what do we know? The US has introduced a set of reciprocal tariffs based on what it perceives as the effective rates imposed by other nations on US goods. For Australia, where the US maintains a trade surplus, we face a 10% tariff, being the minimum rate, though temporary exemptions exist for certain industries such as steel. So what don't we know? There are several key uncertainties. One, the duration. Trump has not provided a definitive timeline for how long these tariffs will last. They could remain indefinitely, but legal challenges and future elections may change that. And number two, retaliation. We don't know how the affected countries may respond with their own tariffs, which could escalate trade tensions, or they could negotiate lower tariffs with the US in exchange for concessions. There is the possibility that these tariffs are simply a negotiation tactic and that in the long run the tariff rates could come back across the board. What is the potential economic impact? So economists are concerned about several possible negative effects of these tariffs. Higher consumer prices, lower economic growth, shrinking profit margins due to rising costs, increased risks of stagflation. So this is a situation where there is negative GDP growth coinciding with rising inflation. But with that said, economic outcomes are rarely straightforward and impacted by so many variables. If these concerns do come to fruition, the US government may respond with fiscal stimulus measures such as rate cuts to offset some of these risks. And while stagflation could be a serious issue, it is important to look back in history at similar situations of stagflation to provide some perspective. So since 1930, there have been 12 years where negative GDP growth has coincided with rising inflation in the US. The stock market delivered positive real returns in 9 out of those 12 years. And interestingly, that hit rate is close to the frequency of positive real returns across all years between 1930 and 2024. So this is an example demonstrating how concerns over the economy should not drive your portfolio decisions. Predictions about the directions of the economy are continuously forming, but the market itself remains the best predictor of the future. So, what has been the market reaction to these tariff announcements? This week's announcements have had a more severe impact than many anticipated, triggering increased volatility across global markets. So equities have taken a hit and declined, and bond yields have also fluctuated. So essentially, the market has responded decisively. It does not like tariffs, mass federal layoffs, or policies that could lead to stagflation. And I think Ben Carlson, he's a well-known US investment manager, has put it quite succinctly when he said, "The stock market remains the last institution that holds politicians accountable for their actions." This is not a political stance I'm taking. I don't have a political party, but I am confident that the share market will keep politicians in check. Markets are indifferent to political narratives. They react to policies based on their impact on earnings and economic stability. Right now, they're signalling strong disapproval. This rapid market movement isn't surprising. These days, recoveries and downturns seem to be happening faster than ever due to the speed at which information is available. So it's not out of the ordinary to experience clusters of volatility like this. So the question many of you may be asking is, how should I respond? So 1, stick to your investment plan. During uncertainty, it's essential to remain focused on you and your investment goals, your investment time frame, and your overall objectives. For some, that might mean investing more into shares during this downturn to take advantage of the lower prices. For others, it might mean doing nothing, holding steady and waiting it out. Both of these strategies are incredibly hard to do and require discipline. 2, understand that market corrections are normal. Periodic market corrections and even bear markets are a regular part of investing. History shows that over the long term, markets trend upwards despite temporary setbacks. Taking a step back can provide valuable perspective. Markets have weathered much more severe global crises and have consistently rewarded patient investors. 3, avoid market timing. Selling to avoid further losses and waiting for a better time to reinvest often backfires. By the time markets stabilise, much of the recovery has already occurred. Even if you successfully avoid a further downturn, the bigger challenge is knowing and having the confidence of when to re-enter. Missing out on just a few of the best days in the markets can significantly impact long-term returns. 4, diversification matters. So history shows that stock markets tend to rebound quickly. The same can't be said for individual stocks or even entire sectors. So while investing does mean taking on some risk for expected reward, you should mitigate risks where you can. Diversification is the top risk mitigation tool, along with investing in fixed income and having a financial plan. While short-term fluctuations are inevitable, a diversified portfolio can help smooth out the bumps and provide stability during periods of market uncertainty. By spreading investments across various asset classes and sectors, you can reduce the impact of any single economic event on your overall portfolio. This is also a timely reminder of the purpose of bonds in your investment strategy. Bonds play a crucial role in smoothing volatility and providing a counterbalance to equities, which becomes particularly beneficial during market pullbacks or if markets are acting irrationally. And finally, tune out the noise. During volatile periods, media headlines amplify fear. They'll focus on words like crashes and billions wiped off the market, but they rarely highlight the billions regained during rebounds. These news stories make it so much harder to stick to your long-term investment strategy. Long-term investment success depends on recognizing that markets move in cycles, and while downturns can be unsettling, they often are followed by strong recoveries. While the current market environment presents challenges, it also offers opportunities for those who remain patient and strategic. Staying disciplined and focusing on your long-term investment goals is crucial in these times. So that's it from me today. If you have any questions or concerns, please don't hesitate to reach out. Thank you.